Hi, I'm Monk and this is the Monk Way. I'll go over the exact steps I personally take to research a stock of interest. This includes research on the company, valuing the stock, looking at earnings reports, and current news. This will give you a simple way to research stocks yourself and show you some good and bad signs when it comes to a stock. Subscribe and hit that bell for more videos on finding good stocks. I make them every day to help you invest better. And leave a like if you learned something new. Step 1. Research on the company of interest. Using Apple as the example stock everyone knows, we start by going to their Wikipedia for a summary. It says they're a technology company that sells electronics, software, and online services. Their products include iPhones, iPads, Mac computers, iPods, Apple Watches, and many other products. Software includes their Mac OS, iOS, iTunes, and Safari. So far, we see this as a very simple to understand company that sells products to make money. We can continue and read the rest of this page along with going to Apple's site for more info. On their site, I see a products page with all their products and services. A company's website is a good way to show how well they run their operation. Apple has a very clean and simple to use website that shows all their products. You can do as little or as much research as you want. The more you know, the better the investment. For more advanced investors, you can Google the company's 10K. This tells you a detailed summary of their business, risk factors, and information about their finances. Here's Apple's 10K with a huge amount of information. It starts with their company background, giving a good summary of their business, then business strategy, telling us how they make money. This is extremely detailed. Everything you need to know about a company is in their 10K. Spending 30 minutes reading up on a company will give you an edge over other investors who hasn't done this. Remember, when buying a stock, it's like you're buying the whole company, hoping for a good future. You wouldn't buy a company you didn't understand. Let's move on to step 2, valuing their stock. This is as simple as going to Yahoo Finance or any other stock information website and looking at the numbers. Here's Apple's statistics page on Yahoo Finance, telling us all the valuation numbers we need. The ratios I like to use are the price to earnings ratio, telling us how much profit they take in. Forward price to earnings ratio, telling us about their future profits. Price to sales ratio, telling us the revenue, which is pure cash before costs. Price to book ratio, which tells us how much money the company has. And debt to equity ratio, giving us an idea of their debts. There are many other ratios to look at, but these are all you need until you get to advanced levels. We can compare it to the average of the American market to see if they're a good deal. The lower the number, the better the value. For Apple, they have a PE ratio of 20.13, average is 24, so they're a better value than the average. Forward PE is 16.23, this is lower than the average of 17, still a better value. PS ratio of 4.2, more expensive than the average of 2.2, so they make less revenue than the average company. Price to book is 9.36, the average is 3.3, so they have less money than average, and they have debt of 0.99, the average is 0.5, so more debt than average. A quick look at these numbers tell us they're a pretty good value. Profits being the most important number, and they're lower than average on the PE ratio. The next step is comparing this stock to a few similar stocks. This is more accurate since the average value of all stocks isn't as good of a comparison. Since Apple is a technology company that makes hardware and software, we can compare it to Microsoft. We'll only use one company for simplicity. You'll want to compare it to 3 to 5 companies in your research. Microsoft has a PE ratio of 53.73. This is over twice as high as Apple, meaning Apple is making twice as much profits. Forward PE ratio of 23.22. This is not bad, but Apple beats it once again. A price to sales of 7.95. Again, Apple is twice as low, so it's a better deal. Price to book of 10.62, Apple is a bit lower. And higher debt in the DE ratio of 1.05, pretty similar debts. Judging by these numbers, Apple is a better deal than Microsoft. Comparing your company to a few more companies like Amazon and Facebook will give you an idea of their value. For a more detailed look, you can check a company's numbers in their balance sheet. This tells us how much cash and debt the company has. A stronger company has more money than they do debt. This means a company with more debt might be a riskier stock to invest in. The price-to-book ratio and debt-to-equity ratio from earlier also tells us this information. Valuation alone does not determine if a stock will go up more than another company. This means even though Apple might be a better value than Amazon or Microsoft, they might go up slower than those two. Valuation tells us if we're getting a good deal and how safe it is to invest in this company. More profits mean more stable growth, more money in their company means less risk, and less debt is a good sign too. To see how fast a stock might go up, we'll check the company's earnings growth in the next step. A huge 100% growth in revenue might spike up that stock by 100%. Step 3. Looking at their earnings reports. An earnings report tells us how much a company made in revenue, profits, and how much they grew in percents. Let's look at Apple's recent earnings. I like to use MarketWatch, which gives us a good summary of 5 years of earnings. Here's the past 5 years of revenue from 2013 to 2017. As we can see, they didn't have continuous increase in growth, some years were lower than others, an increase of 7% from 2013 to 2014, 26% from 2014 to 2015. And they actually decreased in growth in 2016 by 7%, then an increase of 6% in 2016 to 2017. Let's look at their stock price in those same years to see how this relates to their earnings. We can see nice growth from 2013 to 2015, which follows their revenue growth here. But in the middle of 2015, we see a dip in the price, which is explained by this lower revenue growth. From 2015 to 2016, they had a decrease in revenue causing this lower price. But looking at the beginning of 2017, the price is going up again. This is explained by the increase in revenue. As we can see, a company's earnings really affects their stock price. A high-growth company might see 30% or more increases in revenue and profits a year. This usually causes investors to raise the stock price by similar amounts. Revenue is pure money they make before any costs, which is an important number. Profits are also important since this is money they get to keep and reinvest. Looking at their profits, we see similar growth and decrease. From $37 billion in 2013 to $48 billion in 2017. I like to see a consistent increase in revenue and profits from these past 5 years. Apple wasn't super consistent but seems more so now, judging by their stock price. Now you'll want to look at the most recent earnings report to see how they're doing in the short term. We can use a simple site like CNBC that summarizes earnings to see how they did. They reported earnings on July 31st, an EPS of $2.34 versus $2.18, meaning they beat profits by a good amount. Revenue of $53.3 billion versus $52.3 billion, beating revenue as well. iPhone sales were lower than expected at $41.3 billion versus $41.7 billion. This is mostly good news since iPhones cost more now, so less sales still mean more profits. The market reacted by increasing the price, so this is a good sign. It's up 18% from that report. These earnings tell us there will be an uptrend in this stock for the next few months. We can also dive deeper into the earnings just like the company's 10K, by going to their website and finding the complete earnings report. It'll show you something like this. This tells us their revenue, profits, costs and expenses and everything else. It's very useful to understand where their money is going, but generally if numbers are up, it's good news. In the short term, the current news moves a stock's price, so let's look at the recent news in the next step. Step 4, looking at current events. To find recent news of the company of interest, it's as simple as Googling the company and adding the word stock to it. Yahoo Finance has a news section right below the stock quote. By reading the recent news, we can see Apple is releasing some new iPhones along with a new Apple Watch. This should be good news because new products mean more profits. This is especially true of their new iPhones since they cost much more than the previous generations. I would look to see if the new phones have good reviews. If there are any new problems, make sure they're small issues. The Motley Fool is another news source that summarizes a company's recent events well. Just look for the ticker symbol on their site to see recent articles. Reading all the latest articles of the past month or so will tell you the general consensus of that company. It's up to your best judgment to guess if the news will be positive in the future. I would think about the future of Apple. Will these new phones sell just as well as last year? Or will people not want to upgrade, which could affect their profits and the stock price? A company like Tesla might have more volatile news. Recently there was news of their CEO, Elon Musk, causing trouble with the government. By the end of the conflict, he has to step down as the CEO for 3 years and pay $40 million. News like this can drive a stock's price in the short term. Sometimes stocks can move down on good news and move up on bad news. Judging current events comes from experience, so the best thing to do is keep reading the news. Events that aren't directly related to the stock can also have huge effects. The recent trade wars with China has really dropped many Chinese stocks. If you're a long-term investor, this shouldn't matter unless it's so bad that it might kill the company. For swing traders, it's a good idea to get a general idea of what's coming up for the company you're researching. This is everything you should be looking at before buying any stock. The average investor will not do the research, meaning you have a huge advantage by just looking at these pages for 30 minutes. Think of how many people read a hot article about a stock that just went up, and buys that company on impulse. That's how you lose money in the market. This means you'll be buying high and selling low instead of doing the opposite. A well-researched company means you will hold on to it on short-term negative news. If you know Apple well, know how they make their money and see their history, you'll feel very safe even if they dip 10%. You'll understand that Apple fans will keep buying their phones and they will continue to profit, so no need to panic. For a swing trade using less than 5% of your money, you can just do basic research that takes less than an hour. For a longer-term investment, you should be looking at the company every day for a week before buying it. The more you know about it, the bigger the advantage you have over the other 90% of people who only looked at the headline. It doesn't take a genius to pick a good stock, it takes good research, along with patience and removal of emotion. Make sure to join my stock market group where I do this kind of research for every stock I buy. Members get instant updates of every purchase or sell, along with my real stock portfolio with over $300,000. Recent winners include Aurora Cannabis, up 74%, Safar, or $13,000, Canopy Growth, up 25%, or $5,600. Some swing trades in Nvidia up 14%, Shopify up 15%, and Tesla up 10%. All real trades with by-the-minute email updates to members. Look in the description or comments for a 50% off coupon. This offer ends very soon. Get in now to see the best stocks before anyone else. Subscribe and hit that bell for more stock market videos like this. I make these every day to help you invest better. And leave a like if you learned something new. Keep watching to pick the best stocks, the Monk way.